Welcome back. Today we are documenting a market event that did not show up in a headline, did not come from a government announcement, and did not originate from a central bank statement. It came from something far more revealing, a wholesale trade sheet. On Thursday, January 22, 2026, the U.S. precious metals market experienced a failure that cannot be explained by price action alone. This was the day the market did not just slow down, it stopped functioning. In a normal economic system, when a commodity rises sharply in price, buyers become aggressive and sellers become selective. But the transaction itself never disappears. On January 22, that assumption broke. Major U.S. wholesale distributors, the entities that sit between the U.S. Mint and thousands of local coin shops, issued trade sheets showing that nearly all retail silver products were listed as sold out, while multiple buyback lines were marked no bid. This means the wholesalers were neither selling silver nor willing to buy it back, regardless of price. This happened while silver was trading near $95 per ounce in U.S. markets, with physical prices in parts of Asia reportedly exceeding $100 per ounce. At the same time, retail demand in North America had increased by roughly 300 to 400% compared to long-term averages, and industrial demand from electronics, solar manufacturing, and electric vehicle supply chains remained strong. Under standard economic logic, wholesalers should have been bidding aggressively at $95, $96, even $97 per ounce just to secure inventory. Instead, they posted no bid. This is not a demand collapse. This is a liquidity collapse. To understand why, we need to look at how the U.S. wholesale bullion industry actually operates. Wholesalers are not investors. They are volume-based logistics firms operating on extremely thin margins, often $1 to $2 per ounce. Their model depends on leverage. They borrow large sums from commercial banks to buy metal, hedge price exposure using futures contracts, and repay those loans after selling to dealers. The system only works when credit flows freely and prices remain within predictable ranges. Hedging is where the system breaks. When a wholesaler buys physical silver, banks typically require them to hedge that inventory by shorting an equivalent amount of paper silver in the futures market. This is designed to protect against falling prices. If silver drops from $50 to $40, the loss on physical inventory is offset by gains on the short futures position. In stable markets, this is considered prudent risk management. But silver did not move gradually. It went vertical. When silver surged from approximately $25 per ounce to near $95 per ounce, wholesalers were sitting on massive unrealized gains in physical inventory. However, those gains could not be accessed unless the metal was sold. Meanwhile, every single dollar increase in price generated an immediate cash loss on the futures hedge. Those losses were settled daily through margin calls. Margin calls are not theoretical. They require immediate, liquid U.S. dollars. As silver moved from $50 to $95, some wholesalers faced margin requirements running into the hundreds of millions of dollars. This cash came from operating reserves first, then from revolving credit facilities. Eventually, those credit lines were exhausted. This explains the no-bid phenomenon. Wholesalers were not refusing to buy silver because they didn't want it. They were refusing because they physically could not write the check. Every available dollar was being sent to futures exchanges to maintain hedge positions that were originally meant to protect them. At the same time, banks began tightening credit. From a risk management perspective, a commodity that rises nearly 300% in a short period is labeled volatile. Volatility increases collateral haircuts. A credit line that once allowed a wholesaler to borrow 90% of inventory value might now allow only 50%. Even though inventory values quadrupled, borrowing capacity shrank. Here is the math. A wholesaler with a fixed $100 million credit line could finance roughly 4 million ounces of silver when prices were near $25. At $95 per ounce, that same credit line can finance barely over 1 million ounces. The wholesale pipe shrank by roughly 75%, purely due to price appreciation. This is why the system seized. The failure did not stop at the wholesale level. It cascaded downstream. Local coin shops rely on wholesalers to manage inventory turnover and cash flow. When wholesalers went no bid, dealers lost their exit strategy. Inventory became trapped. Cash dried up. Soon, local dealers themselves began restricting or suspending buybacks. The same liquidity freeze spread from banks, to wholesalers, to Main Street. As dealers close or consolidate, price discovery breaks down. Competition disappears. Premiums explode. The bid-ask spread widens dramatically, not because silver lacks value, but because transaction risk has increased. A market with fewer participants always charges a higher toll. When centralized infrastructure fails, trade does not stop. It relocates. Silver begins moving peer-to-peer, outside traditional dealer networks. This is how precious metals traded for thousands of years before futures exchanges and centralized clearinghouses existed. In these transactions, the price is not set in Chicago. It is set between two individuals with cash and metal in hand. This transition is dangerous and bullish at the same time. Dangerous because liquidity becomes fragmented and unpredictable. Bullish because paper leverage disappears. When silver trades peer-to-peer, no futures contracts are created, no rehypothecation occurs, and no synthetic supply suppresses price. Physical metal changes hands directly. What we are witnessing is not a price bubble bursting. It is a distribution system collapsing under the weight of leverage. The modern U.S. precious metals market was built on the assumption of stable prices, unlimited credit, and efficient hedging. All three assumptions failed simultaneously. This does not mean silver has failed. It means the structure around silver has failed. Markets do not die when infrastructure breaks. They evolve. And that evolution usually favors assets that do not depend on trust in intermediaries. The coming phase will not look like the last decade. It will be smaller, tighter, less liquid, and far more localized. January 22, 2026 will likely be remembered not as the day silver peaked, but as the day the middle of the market disappeared. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.